With lingering uncertainty and volatility since the start of the year, investors are continually questioning the market's path and the overall opportunities. So, where are these pockets of opportunity, and how should you be thinking about incorporating them into your portfolio? We're going to discuss that and a whole lot more right now on UBS Trending. Hi, everybody, and thank you so much for joining me again. I'm Anthony Pastore, and this is UBS Trending. Please join me in welcoming to the studio Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management. Eddie, nice to see you in person.
Thanks for having me.
Our audience who knows you and knows you being on the show with me knows you're always virtual, so it's good to have you here in the city.
It's good to be here.
Yeah, great. Glad you're here. It's a really opportune time to talk to you. As I was saying to you earlier, I love that you come in with really strong convictions and investment ideas. I think one of the big questions that has been continually coming up, especially since the beginning of the year, and we could go through the whole rigmarole of what's happened, but at the end of the day, there's been some volatility. We had a new White House come through. We had some really strong jobs numbers. We have inflation that continues to remain sticky. What are you seeing right now in the markets, and do you expect this kind of volatility to continue?
I do. We told clients 2025 is going to be a very challenging year. There's going to come down to stock selection, and I do think you have to have you're going to be expecting a lot of volatility. And I think one of the biggest issues we have right now that this market is going to have to decipher through is interest rates. And inflation, because those things are tied together.
Yeah.
I think the market is pricing in a little bit more favorable data than what we anticipated our firm. When you look at the money that's pouring into the economy's strong. Markets have been strong. Even with the volatility, we've been spoiled, okay? So this volatility is actually healthy. However, if inflation continues to be sticky or even accelerates, I think the 10-year bond could go towards 5%, and that's our base case. So you're going to have to navigate and get through. Right now, the market looks good. Even with the tech issues that we've had, it's broadened out. We've added financials to our portfolio here recently, which we haven't had in a while because we think M&A activity is going to really pick up. But you're going to have to be able to move and move quickly and be nimble.
Right.
So we need to be ready for an air pocket that I think is going to hit this year.
Yeah, and I don't disagree with that. I think obviously the uncertainty still continues to be a part of the story, and we keep saying diversified portfolios are really what you want in this particular environment. I think, with the Fed in mind particularly, and we talk about inflation all the time with you as well, the Fed has an interesting kind of path ahead of them. We now, by the way, here in our UBS Chief Investment Office, think we're going to see 50 basis points of cuts this year versus we thought 100 last year. But the thing is now, President Trump has come out and said, I will make sure that the Fed cuts rates. And the Fed now is sort of at what do we do? Do we kind of say, okay, we're going to do that and look like it's a political move? Or do we be contrarian at the risk of, causing market volatility? The Fed really, I wouldn't want to be Jay Powell right now.
No, they're in a really tough spot.
Yes.
And because here's the interesting thing. The most important interest rates that we really want down, to be selfish, is the 10-year bond.
Yeah.
Well, ever since they started cutting rates, the 10-year bond has actually gone up. So I argue that if you don't cut and keep things somewhat tight, that the 10-year bond may actually go down. If they cut rates aggressively, that's going to cause inflation to get even hotter, and the bond market will sniff it out. And that's what the bond market and the dollar is signaling right now is we're in a pretty decent spot right now. If you add fuel to growth and to inflation, that 10-year bond is going to go up. So if you want interest rates down, it's counterintuitive.
Yeah, it
you
is.
don't want the Fed to cut rates.
It's crazy. It is counterintuitive. It sort of goes against everything we've learned in our economics classes and what you read in the papers. But the markets obviously are, consistently fluid, and we have to. That's why we have experts like you and our people in our chief investment office to make sure we're digesting this stuff. But I know that there are some challenges, especially now with the new administration. We've had the conversation continuing about tariffs. Nothing definitive at this point, but it seems like it's coming. And we've got government spending. I mean, it's just continuing to rise. That's a challenge, isn't it? I mean, not only for the Trump administration, but for the markets.
It really is. And here's the thing, we know we are on a path of destruction if we continue to spend at this rate. And I don't want to sound drastic, but it really is. We have a third world country balance sheet at this point in time. The challenge that the Trump administration has is the things that we need to get done for the betterment of this country is not going to be for the betterment of the market in the near term. They say they're going to cut spending. If you're going to cut spending and put tariffs, you're going to have a strong dollar, high rates, and cutting spending. That's going to suck liquidity out of the system. And this is the air pocket we've been telling clients that we expect sometime this year. The sooner it happens, the better. It's kind of like one step back to take several steps forward. So we think we're going to see some type of correction, a decent-sized correction in the S&P starting sometime mid-year, but it'll be in a non-recessionary environment, so we think it's going to get bought up right away, and that's going to be a function of the dollar, rates, and reducing the government spending. It has to get done.
Yeah. How much do you think that is going to weigh on consumer confidence as we continue to go through the year? You're talking about a correction. Corrections happen quite often, but you say, oh, they'll buy it up right away. Is it consumer confidence that you think will play into that, or is it really more fundamental?
I think it's going to be more fundamental because, again, if you have a big correction, or I call anything over 20% a crash, right? So if the S&P drops, say, 20%, and we're not in a recession, and we have an administration that continues to bring pro-growth policies, they're talking about bringing the tax rates down even more on corporations.
Yeah.
The rest of the world is in a stagflationary environment. The U.S. is the best place to be right now. And so the timing of getting this done and ripping the Band-Aid off couldn't be any more perfect for this new administration.
Yeah. I mean, the challenge also, we look at the jobs numbers that just came out for January, really strong. And employment actually fell, to 4.1%. So obviously there's a long road ahead of us of more jobs numbers and claims. And then obviously the things like the consumer price index, that inflationary data. So obviously the Fed's mandate is to keep inflation tame. And then we have this new administration that's essentially demanding, not that the Fed has to listen to that because there is a mandate to keep things separate. So where do you think the opportunities sit for investors, and what is the bond market telling you about the direction of where we're going?
So the bond market is telling us that inflation is not going to get anywhere near the 2% target that the Fed is leading us to believe that we're trending towards, because we're not. And so the bond market is telling us that monetary policy needs to stay right where it is. They don't need to raise rates, but they certainly should not cut any more rates at this point in time.
You're talking about for 2025 at all?
That's correct.
Okay, got it.
Okay.
Got it.
The market won't like that at first, but it's okay, again, because we are in a healthy environment. And this market is broadening out. So I think from an investor's standpoint, the next decade looks really, really good once we get through this air pocket. Small caps is an area, it's been a pain in my you-know-what over the last 2 years because we've been in and out.
Yes.
But with small business sentiment has soared since the election, and I think you're going to see small caps start to catch fire. I think you'll see financials catch a bid. Maybe things outside of the AI space is actually going to be a good place to invest for investors. And I think that's a good place to be this year, is broaden it out and don't just be so 100% focused on tech.
Right. And I think, when you look at small caps, I know you've been liking small caps, but again, as you said, they sort of challenge you. We have a neutral on small caps here, but do see the fact that, there are better earnings trends within the small cap space, and there's enough AI adjacent there are enough AI adjacent companies to really make it compelling. And as you said, there's more than AI happening in small caps that does have some opportunity. So it seems like, what about large caps? Where do you feel with that?
So still, we're still going to always be overweight large cap because they're going to have less volatility, hopefully. And they're still, like mega cap tech is probably still going to continue to be the leader. I mean, whether we like it or not. The problem that we have with the way this market is they're so heavily weighted in the indexes that you almost have to own them.
Right.
And so we're still overweight tech. We're never going to have more weighting in small caps than we would in large caps.
What about this DeepSeek story that we've seen in the headlines? When it initially crossed that they launched their R1, it really took down some of those mega cap tech names here in the U.S. Although interestingly, DeepSeek released version 3 in November of 2024 with nary a headline. Maybe there was too much going on here with the election and people weren't paying attention. What's your thought on DeepSeek? Does it actually kind of feel like it could be truly competitive for U.S.-based AI-related stocks?
It does, but it doesn't quite pass the sniff test for me yet, right? Because
Okay.
it comes out of left field, and I still don't truly believe that they were able to make something so fast that's so much better than what we have at a fraction of the cost. So it doesn't add up yet. So we still have to continue to do more due diligence on this. The other thing, too, is, this is a company coming from China. We just banned TikTok because we thought it was a threat.
Right.
Well, now we have a company that is from China that they can take, they'll have all of your information and data. Is this administration going to give them the green light to do that across the board? So if it is as good as they say it is going to bring some of these stock prices down to levels that much lower than where we are.
Right, and with this private sector investment from the Trump administration of $500 billion to fund infrastructure related to AI, it seems like it might be in their best interest to kind of make sure they're doing their due diligence on companies like DeepSeek that are outside the U.S. and could potentially have security risks. Eddie, thanks so much. Good to have you here.
Thank you. It's
I
great
know
to
there's
be
a
here.
lot more we could talk about. I wish we had more time, but we'll get you back in.
Thanks for having me.
Good to see you, Eddie. Eddie Gabor, thank you very much. And for more information on anything that Eddie and I talked about, there's lots of content up on our website, ubs.com/views. Plus, UBS has lots of content all over social media, LinkedIn, Facebook, and X or Twitter. Plus, you can check out our Instagram channel at UBS Trending. Give us a follow there. And as always, if you have any questions about what we spoke about today, make sure you're chatting with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.